So it's my pleasure to introduce Mr. Dutta today. Mr. Dutta is a regular speaker in AIT's programs, and he brings to you a wealth of experience uh, from diverse fields, all of which have a bearing on the subject matter that we are covering today. He was formerly a partner with Pricewaterhouse Coopers, where he was a partner for 18 years. And since stepping out of Pricewaterhouse, he runs a well-recognized consulting and research company called Thought Arbitrage Research Institute. He is an independent director in many large Indian corporations. He has also authored some well-received books, especially in the area of corporate governance and the functioning of independent directors. He writes regularly in academic and professional journals as well as in the popular press. Notably, he has served on several committees of organizations such as RBI, ADB, Ministry of Corporate Affairs, etc., on subjects such as risk, fraud, and governance. And from this vantage position, he has had a chance to observe the practices of banks, especially in the context of India. And I'm sure he will bring that experience to play in today's session. So please join me in extending a warm welcome to Mr. Dutta. And thank you very much for your time, Mr. Dutta. And now the floor is yours.
Thank you, Professor Venkatesh. Thank you, AIT, and thank you everyone for joining in on a Saturday morning. And for those in Bangkok, it's a Saturday afternoon. The subject what we are going to talk about is after the bust. Just the function of, if you look at giving out a loan, if banks do not give loans, then the bank is not in business. Bank's business, fundamental bank's business is to balance your debit and the credit side, your assets and the liability sides. The liabilities come from all the deposits you get, from citizens, from inward remittances, from the government, from investors. And on the other side, you would be lending these out to either as an investment, where you actually maintain your capital adequacy ratio, you maintain your liquid ratio, and on the other side, you give it out to retail investors, to corporate investors, to retail borrowers, to corporate borrowers, and anyone else, to sovereign borrowers, to anyone else that comes in between. The fundamental thing about business of a bank is to have the spread between the deposit, on the interest that you give in the deposit, and the interest that you earn on the loans that you give. The loans that you give has got a risk. The deposits on which you give interest, fundamentally that's absolutely secure, and that's for a bank and for a class bank or a government bank, it's as good as a gilt or a sovereign security. And so that means that liability is fixed. But what is not fixed is your ability to absolutely be sure what would be the earnings that you have from the loans that you're given in. And that's where the risk, that's where the monitoring, that's where everything else about the banking business is on. So what I will now do is I will share you the screen, and that will be the basis of which I will run my presentation for roughly about 30-35 minutes. And then we will run a longer Q&A. So can you all see the screen?
Yes, Mr. Dutta.
Okay, fine, perfect.
Yeah.
So we move on this. This is basically the Nepal Rashtriya Bank's definition of what is an NPA. And the NPA, you divide NPA as a substandard asset, which is for which the installments have been not been paid for 3 months, between 3 months and 6 months. Doubtful assets is something on which it's a period of it's a period of between 6 months and 12 months, and bad assets are ones for which the installments are due over 12 months. This is a definition, but it is not a hard and a fast rule. What this helps you is, what this gives you a guidance is at which point of time you need to start making your provisions. And an asset could actually turn bad even before 12 months, or a substandard asset could actually become a standard asset within a very short period of time. And loss assets are those assets in which you have decided, based on the bank's internal and external auditors, your internal policies, your your investment committee, and everyone's after everyone's decision and review, you would actually decide to write it off fully. In other words, these are your uncollectible debts or deposits. This is actually a research that has been done by Seema Bhattarai. I thought, when I was looking at this, I thought, preparing for your presentation, I thought this was a good piece of research. This was information that she collected from 140 bankers bankers in commercial banks in Nepal. And what does all these bankers of commercial banks talk about? What are the risks of lending? And risk of lending and the risk of going bust and how you collect is very, very interrelated. Because this will actually determine how much you will recover. The bankers actually say that government budgetary expenditure and unstable political environment is one of the biggest reasons for non-performing loans in Nepal, which fundamentally means that unless the government spends at the right time, it doesn't stir up the economy, it does not create the economic engine, and anything that is unstable political environment creates high NPAs in Nepal. Similarly, the bankers also perceive that honesty in disclosing information and better monitoring and evaluation of loan have got significant impact on non-performing loans. That means the quality of the information that the person gives at the time of screening, and also the KYC and other checks that the bank has done, and all other loan evaluation process. And then after the loan has been given, the quality of monitoring and evaluation. If these are not done well, then the chances of the loan becoming bad is extremely high, which you of course know. But they also think that the macroeconomic variables like unemployment rate, inflation, exchange rate, interest rates are not very important for influencing a non-performing loan in Nepal. The other thing that actually is very important is the GDP rate. If you have a high GDP rate growth, then in those years you have low non-performing loans. The reason for this is, around the world, when there is a GDP is high, and Nepal's GDP in the last few years has been nearly double digits or close to double digits, there's an euphoria. Everyone gives out more money, and no one wants to bust the bubble when the going is good. So the loans pile up, and because everything is actually going up and there is a euphoria, you get into a cycle. And then when the growth slows down, suddenly you will actually see a large number of non-performing loans coming out. And this happens economy after economy. So if the growth, see, one of the big events that has happened in all the variables and everything that we talked about, and we will talk about in the future, is the impact of COVID. If you look at COVID and number of loans that you will actually have to reconfigure, rebalance, and relook at post-COVID scenario will be a significant part of your jobs. Whether it's a personal loan of an EMI of a salaried borrower, whether it's an EMI, whether it's a small loan for against small assets of a shop, of a small business, a large business, a conglomerate, everyone has got a COVID effect. And this COVID effect will actually rebalance your entire loan portfolio and including the collectability. So events, even though large events like macroeconomic events are not important, but then you could have watershed events like COVID, which would completely change the way we look at lending. So there are a few other things from this research that I would actually say which are quite important. The one is if you look at the fourth one, it says in the third one. No, sorry, this one. Government-owned banks. This research says has got higher chances of having an NPA. Fundamentally, because government-owned banks everywhere else lends more to priority sectors, to other sectors when commercial banks normally don't lend. So hence they have higher level of NPAs, which is across the world. The other thing is that better monitoring obviously would reduce your loan performance. And one more thing which is very typical to Nepal and probably most of Southeast Asia is a result of monsoon. If you have a good monsoon, we reduce non-performing loans, because if you have got a high capital adequacy ratio and you fundamentally have a good profitability or a return on assets. Which means that if you're managing your balance sheet well, you are fundamentally strong. The second thing it says, the non-performing loans to the total loan portfolio, if you have high, you have an overall negative impact on your profitability, not just because of the loan going bad, because you probably take far too many risks, which actually comes out in the other parts of your financial well-being. The next one is the capital adequacy ratio, which means like total loan to total deposit. That means like your cover on your loan or cover on your deposit. If that is good, that is if you're turning your deposits two times over, then you create a high profitability, provided your NPAs are below 1%. The other thing is that the financial analysis needs to be done, which is not something that you don't know. Of course, everyone knows, and very often the loans actually turn bad because we haven't done enough KYC and loan screening parts. When you look at the loans in Nepal, bank loans, in 2015, when you had the new monetary policy, which we're talking about consolidation of BFIs, only 2 out of the 31 banks actually went for a merger. So that meant that you still have a lot of small BFIs which did not get into a merger. So you have fundamentally Class B and Class C banks in a risk management profile. So that means some of the banks are not as robust as the policy wanted them to be. And that would mean that there would be a lot of pressure among the banks to compete, to get more loans, to give out more loans. And in that case, you actually make decisions in which you give out loans to borrowers who are not all that creditworthy. So if you look at the graph out here, the the dark green is the deposit, and the white green is the credit. Uh, if you see, the credit and the deposit have been moving up, and they've been moving pretty close. So that means there has been an intense competition that's going on to give out more loans, and the credit to deposit ratio has also been going up. So fundamentally, that means that you have actually been from a leveraging your deposit portfolio, you have actually kind of gone very close to maximizing it. And at this point of time, your headroom for giving out more loans, unless the NRB allows you, is not, as a banking system, significantly high. The other thing is that, if you look at your credit growth rate has actually been going up, which is your graph on the right side, at a much higher rate than the deposit growth rate. That means you're actually giving out more credit for the A-class banks than the growth in deposit. So that means at some point of time, when you give out too much credit at too fast pace, obviously the monitoring and also the due diligence on the credit becomes weak, and this on a later date could actually turn into a NPA. So what is the NPA percentages? If you see, the NPA percentages in Nepal has been coming down from 260 to 166. For your bank, it's actually even lower. It's about 0.82 or 0.84, depending on which year you're looking at, whether 2019 or 2018. So from an NPA point of view, it's very low. But then again, there are some banks which actually have got an NPA of 5, and some banks which have got an NPA of 0.82. So the averages can be misleading. And also, because your credit has been going up significantly, much higher than the deposit. So that means that even though it's lower now, it could actually be a significant risk on a future date, because of a simple reason is that at this point of time, it is hidden because the deposit numbers are going up. So that if you take a fraction, if the denominator is going up every year significantly, then the fraction actually becomes smaller. Same logic. So here, and this is a research, this is a research that is done by ICRA. ICRA is a Moody company. Moody is one of the world's largest rating agencies. This is a research of theirs on Nepal banking system. So here they actually make the same conclusion, saying that the NPA level for commercial NPAs continue to decline, partly masked by high credit growth. So the credit is going up, the denominator is going up, hence the fraction is coming down. But that doesn't necessarily mean it is it's a great case to be happy, and it's a great case to be happy as long as you can keep your NPA and the loans from going bust through a number of mechanisms that you can look at. And the other thing is that because you have a large number of banks, the competition of a player from business and large borrowers using multiple lines of credit makes it very hard to assess the true stress on a borrower. That means the same borrower is borrowing from about 3 or 4 different banks, 3 or 4 different credit lines, and hence the total stress on the borrower cannot be assessed unless all the banks get together and do one assessment. So this is the other thing that actually keeps the stressed assets realization or discovery of stressed assets that much harder. So if the borrower was taken from the one bank, it will be assessed very, very quickly. But if it's taken from 10 different banks, by the time the 10 banks get together and the truth is assessed, very much like some of the big frauds, and I heard Kingfisher, one of your case studies, it happens that way, because if you have taken so much money from so many banks before the banks all got together. Water has flown under the bridge. What is the impact of NPAs? Impact of NPAs, it leads to credit management risk, assuming priority over other aspects of bank functioning. So what happens the moment you have a high NPA, everything, all the lending gets clamped down. So that means the bank's functioning of actually getting a higher yield on the higher interest yield to pay the depositors, that first gets compromised. What is the second thing? The capital adequacy ratio gets disturbed because the NPAs take away your total total recoverable loans, and hence you need to have more money, more liquid assets, and you have to improve your liquidity ratio so that the bank does not become a bank under stress. So if you have too much losses in your deposits, sorry, in your credit, then you earn less, and hence at some point of time you would actually start offering depositors lower returns, lower interest rate than what the profitable banks can do, which would mean that your depositors will move away from your bank to another bank. The other thing is that borrowers will have to pay a higher rate of interest because you do not have the bandwidth to actually give loans out at a lower rate of interest because you have to compensate for the back loans. Reputation is obviously a one that follows from it, and the increased failure due to bad. So your projects, because if you cannot infuse more money, and when you look at things like a moratorium, and when you look at haircuts, when you look at putting in more money into your loans which are stressed, if you cannot do that because you already made bad investments and you do not have significant amount of money, the chances of your investments which are stressed now, which could go bad, increases significantly because you cannot put in money to turn it back. And obviously the liquidity gets influenced. Why do loan accounts get bad? I mean, if you look at, and I think some of it you have done it already. So I'll just be very quick on this. From the point of view of borrowers, I mean, this is the part of that the borrowers actually create the loans to go bad. Failure to bring in required capital, too ambitious the project, very long gestation period. By that time, the markets have moved, everything has moved, COVID has happened. Unwanted expenses, which means like they have either spent too much on things that are not important, or they have spent money on being extravagant, being diverted, over trading. That means they have made too many promises and have given you projections that would never be materialized. Imbalances of inventories. That means they could never balance the final inventory. That means what they're going to sell to the purchasers, to the raw materials, and hence the entire supply chain and the trading and the business cycle are not in sync. There is no proper planning. Either dependence on single customers. That means one or two customers they sell everything to them. If it's the government, it's fine. If it's not the government and the customer goes bust. Often we actually give loans to people who are first generation businessmen, and not necessarily they always have the expertise to run businesses. And that's something that even in this startup environment, to the extent at which you can actually give loans to people who have never done a business, is something that as a bank, you have to be quite careful. That's a risk that the venture capitals and the private equity take. The amount of risk on this the bank can take, that's something that a call that you'll have to take. Working capital management, I mean, they either do not have enough float, not enough working capital, or they use long-term loans to fund working capital. Mismanagement, that's fraud, diversion. They don't have management skills. They're too heavily borrowed. They cannot collect their debt. Overall lack of quality. From the bank's point of view, wrong selection of borrower, credit appraisal not being sufficiently robust, unhelpful in supervision. That means like people who are supposed to supervise, they have not been supervising enough, or they have uh, not taken it as seriously as it should be, because often because the supervisors or the auditors or the bank employees who are in charge of supervision did not supervise as regularly as they should, and as often as they should, and as deeply as they should. If they had done that, a lot of these loans would have actually not gone bad. Either too inflexible in attitude, that means that we actually do not give the borrower any leeway in the terms, which at times can actually become very, very difficult, because situations change, and there are times, especially with the government banks, if you just go by the letter, it it can put borrowers in great difficulty. And I'm not saying that you overlook it, but flexibility and risk can at times be managed. The times that the bank systems are so overloaded that they cannot effectively spend enough time looking at a loan, looking at this monitoring, looking at looking at all the data, the back office, non-inspection of units. We talked about it. There are times it's also an individual thing that the staff doesn't feel motivated. Especially it happens with banks that have got older staff who, after a point of time, are not as agile like me. There are times, the delay in sanction is so much that by the time the sanction comes, that the project has already passed its prime. Often that the banks do not have trained staff, and then because you do not have trained staff, the review is not as robust as it should be. There are times you get government's directions or the bank's directions because you had a series of bad loans, not to give out credit. So somebody who wants a top on credit, you are unable to give. So the project actually suffers. And also there's a lack of commitment to recovery, because there are often people in the bank think that it is not their money to be recovered, it's the bank's money. So they don't treat the money as much as the bank's money as their own. And all these things that I'm talking about in the last slide and this slide, this may not be true with Nepal, but this is certainly comes from the experience of banks in India, and this comes from a report of the banking industry, and also from the government banking sources and other research. And I would think that some of this would be true across the world, but some of it would not be true for some specific countries. The macro means like at the level which is not in the hands of the borrower or the bank, when you can go back, you have a sluggish legal system. That means like, even though I have got the legal rights to sell a property, but if it takes me 20 years to sell the property, neither will the bank recover the money, neither will the business be able to run its business. The times technology changes, you have given, let's say you have given money for something, loan to a business that actually makes product which is 100% contact in the time of COVID, but 3 months later, that business might actually not be valid, because the world has moved into something which is completely contactless. I mean, as something as simple as that. There are times banking government priorities change. We move from priority sector to definite in infrastructure sector, and then from infrastructure sector to small scale sector, to priority sector, to agri sector. So as much as the government priorities changes, the norms of lending changes, and that could actually create a stress. The others is there overall increase in material cost, Uh, if the price of oil has gone down and the price of coal has gone up, how does it affect uh, thermal energy? If you're lenders to thermal energy, changes in customer preference, consumer preferences, uh, that could make a completely industry robust, industry bankrupt. What example do I give? Let's take a camera. Camera today is only in the hands of very professional uh, camera professional camera persons. Otherwise, you don't buy cameras unless you are a very big enthusiast. So the industry of cameras has gone away. So similarly, Xerox machines. So consumer preferences, technology actually takes away complete business lines. Credit policies, changes in taxation laws, which could make a business completely unviable. Civil commotion, political hostility. These are macro events that there's nothing that as a bank you can do. And these are the overall environmental risks. Problems of NPAs, whether it's in Nepal or in India or any of this, is more in the public sector banks, because public sector banks take higher risks. At the same time, the private sector banks and the government banks and the foreign banks take lower risks, but they're also smaller. The public sector banks are larger, but the private banks are always more profitable. Credit monitoring that you do, pre-disbursement, got to make sure. One of the fundamental things about after going bust is to make sure that your documents that you have are legally enforceable. I have seen so many times that the bank's securities are either not legally enforceable, or they are forged, or they are lent, or five banks have lent on the same documents without checking with each other. So after the bust, the documents based on which you have given loan, your fundamental collaterals, if they are not cast in kind of stone, and they are not something that you can just to take it, and if it's not guilt, then there is nothing, then you have no assets in your hand, then it's like an unsecured loan. So this is one of the fundamental things about credit monitoring. The documents have to be legally enforceable. Ownership, title, the fact that they can actually give it to you without anyone else's rights being impeded upon. End of use, that they are spending the money as the loan agreement requires, and they're not creating a diversion of the bank funds to bank money to either personal, to subsidiaries, to third parties. Security offered to the bank against the advance being physically and legally recoverable. There are times, you get assets which you can't even physically recover, because an asset given in a remote part of Nepal behind a mountain, you cannot physically recover. Even if you recover, you cannot sell it. Same thing, there are times collaterals have been given in such remote areas that they cannot be physically even gone and and taken possession of. And you've always got to look at prevention of rather than correction. As much as you can do preventive, the better is the chances of you getting out of the bust. Some of the early warning signals, and you have done this before and you know it, that you just got to keep looking at your clients before the bust to see if any of these are happening. You have unusual entries, you have frequent return of checks. If they're actually not paying, let's say, the government dues, not paying salary dues, not paying the provident fund, not paying things which otherwise you ought to have paid, you have this warning risks. Frequent overdrawing, low turnover in the account, but at the same time high expenses, frequent transfer to an account not connected with the business, non-submission, delayed submission of stock statements, accounts. There's no MIS. You have a huge difference between the accounts they give you and the accounts that the auditors give. So all of these things create an early warning signal for you to make sure that you get into the preventive before the bust rather than the corrective. We'll just go with this, and if you look at the preventive, it's the same. It fundamentally goes to the same ones that that you would do as a normal person, giving out a loan to somebody that is not your relation. If you were to even give money to your friend, you would do a KYC, or a friend's friend. You had some surplus money and you got to give it to a friend's friend. You first want to see is that who's the person I'm going to give to. Then you look at, is the person creditworthy? So you would look at credit reports, you would look at tax returns or any other documents. You would see that, whether he can actually bring in some money to reduce your risk, whether he's putting some skin in the game. If you have a credit report like a CIBIL in India or an equivalent of that in Nepal, you look at that, whether he's in a willful defaulters list, whether he has, you'll make a few inquiries to say whether he has, how is he? Does he actually not, is he trustworthy? Does he pay other people's loans? Has he ever defaulted? So it's fundamentally, if you look at it, it's exactly the same thing you would do with your own money. Same process. Often we don't do it because it's the bank's money. And that's where the risk comes. But if you follow or there's a pressure, there's often that happens in India. I've seen that it's a pressure that, you get pressure from different constituents to advance a loan where not necessarily all the paperwork is in place. Post-sanction state preventive measures, acceptance and conditions of the sanction, very important. What are the terms? What are the conditions? Documentation and legal compliance certificate that everything is legally complied. The security documents are all there from end of use. The securities are charged to you if it's a secured loan. If it's an unsecured loan, then you just got to make sure that you have vetted the borrower, and that is more difficult to do than when you borrow, when you lend on a collateral. If you lend otherwise on a collateral, then it is the person's trustworthiness is all you are betting on, and his education, he's looking at all the other things that would actually make him somebody who can return the loan. So stock audits, information system, offsite monitoring, inspections. So now we get into the technical part of what happens when a special mention accounts, or what we call is a substandard account. When the lender has actually, when the borrower has not been able to pay after 3 consecutive installments or 6 consecutive installments, depending on what rule you're looking at. Say that they have not been able to pay 3 consecutive installments of the principal, then you specify them as substandard assets and or special mention accounts. So that's the first time at which you actually have started looking at the account in a careful manner of looking at this as an account that is at risk. So there are a few things you can do. You can actually look at it and say that if you are stressed and you cannot give this money at this point of time, what we can do to regularize your account. So one thing is that you can ask the borrower to put in more money to regularize the account, so it becomes a regular account and not a substandard account or a special mention account. or it does not slip into the category of non-performing assets. So that's the first thing, is try to see if the borrower can rectify it themselves. The second thing is that if it's one or more banks, let's say if there are more banks, then you can technically have what is called a joint lenders forum. That means all the banks get together with the possibility of restructuring the debt. And if it's primary, if you can only do that if the borrower is not a willful defaulter. And then you can use the corporate debt restructuring mechanism, the CDR mechanism, which I think in Nepal they brought it out in 2005. And this is and then you sit together and see how you structure the stressed assets. And if one or two are not possible, then the person cannot bring in accounts, and you cannot restructure the stressed assets. Restructuring your stressed assets would mean that they bring in some money, you give them some money, they bring down their expenses, they give you a revised cash flows, you evaluate the cash flows, and then you ask them to say, put in some more skin in the game. They could bring in more debt, more equity. They could bring in a new lender. They can do all of that. They can put in their personal assets. You do all of that to be able to give them some more money. But the most important thing, it's not something that you do because you want them not to be stressed. The fundamental question is that when you lend money to somebody who's stressed or somebody who's not adhered to the terms at which you have engaged with them at the beginning, is what has changed in the whole scenario. And that is what you need to be satisfied with, that there's a genuine reason for them, that there is a change in the environment that has happened. And if you put in more money, that will rectify the situation, and the debt will not go bad, and the loan will not go bad, and hence you will not have to have a hit. Or otherwise, the risk is that you already have a bad assets, you're throwing good money after bad, so you have two bad assets in your hands. So it is not something that you automatically do. You will only do it when it is required, and when it satisfies both sides. It satisfies your need to get the money back, and your safety has been enhanced, and also the actions that the borrower is going to do is something which is very, very well laid out, and you will have somebody from the bank who will actually monitor all of it. And if that is not possible, then you file suit under the Debt Recovery Tribunal and serving notice under the liquidation laws. How do you recover tools? What are the asset recovering tools? One is asset reconstruction. So if you have, in the morning, Professor Venkatesh was talking about of hydro assets. Suppose you have a borrower which has got a hydro asset, which has got a thermal asset, which means coal generation plant, and he's got a let's say a tourism. So if all of these are lent to a bank, you might actually do an asset reconstruction and say that I will sell off the hydro asset to X through a bid and through an open market, and then the two other assets, I will actually convert that into one company and sell the shares of that company to another lender, or so to another investor. So asset reconstruction happens in many, many different ways. You actually you try and first, the sale of an asset will give you a lower price because all you will get is the replacement value or the written down value or the market value of a depreciated asset. Than if you reconstruct the asset into a business. If it's sold as a business, you'll get a higher price than if you sold the asset, which comes to the next part, enforcement of security. That means all the security that has been given to you you can actually sell the security as long as you have the title. That's why the point I was making, the title has to be very, very secure. As long as you have the title, uh, then you can actually sell the security, but you will actually get a lower value than if you could reconstruct the assets and then sell it. And securitization is that if you can't get the money straight away, you would actually create security or small shares of that entire asset and sell it to many people. In India, you have this act which is called Surface Act, which is basically the liquidation act, in which the bank, if the amount is less than 20% of the principal or the principal, and then what happens is that the bank can actually sell anyone the assets of that company, but the buyer cannot be anyone who has been involved with the management of the company. So, which is actually a very, very important rule that earlier what used to happen is that I would be a large corporate borrower. I would actually take the company into a loss, and then I would declare myself bankrupt and then buy the assets of the bankrupt company at a very, very throwaway price. Now the rule is that these assets will be sold under the supervision of what we call is a is the liquidation professional, insolvency professional, and under the supervision of the banks. And the fundamental rule is that whoever buys cannot have any kind of a direct or indirect relationships with the management of the company. Otherwise, both are criminally liable. So now what has happened because of this law, the borrowers are not willing to let the company get into this kind of situation unless it's the business has really gone south, so that they don't buy the assets back at a throwaway price. Debt recovery. So you basically take care of your secured assets, lease or sell the assets, and then appoint someone to manage. So this is appoint someone to manage. The same would mean that very often under some laws, you can actually take over the management of the company. It happens that the bank says that I would actually instead of a loan, I will convert the loan into equity. But if I convert the loan into equity, I will have two members of the board who will be bank's representative, and all money that goes out will actually be signed by the two representatives of the bank sitting on the board. So there are different manner by which a bank could take the control or control over the assets and control over the business as it wants. And in 2002, the Nepalese government brought in the Debt Recovery Tribunal for financial institutions, which is on the same basis that the banks get together and the tribunal actually determines. So you don't have to go to the court. The tribunals determine the method by which the debt would actually be recovered from the borrower. Arbitration is one, which is in which both parties, if there is a major issue in reconciliation, that there is a doubt on terms and conditions, you can actually have an arbitrator and decide how much of the money to be paid. And compromises when borrower and the bank sits down and comes up with a solution that how much of haircut will the bank take and at what period of time. So it's nearly 12, so I'll take another 5 minutes and I'll try and finish this. Haircuts is something which is banks never love it. I wouldn't love it, and no one loves it, which means that the bank forgives either a part of the loan or part of the interest or part of both, or converts the loan into equity or forgives significant parts. And when a haircut is given, you have to be sure that what is the borrower doing to make sure that the balance will be paid. It cannot be that you give a haircut and also at the same time that the that the borrower is in no position to actually pay the balance amount. So it's very important at that point of time that that entire business gets restructured, new assets are put into it, you have control over the cash flows, you have control over the assets, and you have control, and you have a very, very good oversight of the business. Moratorium is like when you suspend the interest payment for a certain period to help the company with the cash flows, and you create a gestation period. You say that after 2 years you start paying interest, but that doesn't mean you have forgiven the interest. The interest actually gets front-ended, back-ended. So when the interest actually gets putting in later. So moratorium is merely suspension of interest, but not forgiving of interest. You often do that with housing loans and other loans, so that the borrower doesn't have to start paying interest straight away. So you give them a period of 5 years, and you start pay, so that the first they spend money in building the house, and after that they can start paying the loan. So same principle, but you haven't forgiven the interest. You have merely suspended it for the future. Collateral, you can only sell the collateral only when you have, first of all, a market. The example I was giving you, if you have an asset in a very remote part, it is not a marketable asset. So one can accept such assets as a collateral at one's own risk. I've seen this happen a few times, in which the collateral was something that you could never take possession of, because the bank couldn't send people to take possession of the assets because of the people guarding the assets would never let the bank people come anywhere near them. So it's that kind of a situation that could come in. In a remote place, you do not have a market. So the assets that you take as a collateral have to be marketable assets. And the last one is insolvency. If the borrower declares himself insolvent, if the borrower is unable to pay, then you take over in the entire assets and you sell it in the open market. And whatever you get out of rupee to the loan, rupee to the that loss will that be of the bank. And yeah, and when the company goes into a liquidation, the bank as a borrower will get paid if you're secured, you will get paid before the unsecured creditors, and secured creditors, then the government dues, everything comes in. So you do not necessarily get in a liquidation, you get the best deal, but it's still, you get paid before the equity shareholders, the priority shareholders, the promoters, and the unsecured creditors. But liquidation happens very, very rarely. You should, as a continuing banking business, is as much as you can do preventive, the better it is. If it's corrective, the best thing to do is have your collaterals which are gilt-edged, and it's completely safeguarded and secured for sale. And that's probably the two best ways, and also to be able to work with the borrowers as much as possible, to be able to give them money at the right time if they're borrowers who are honest and who are actually running their business in the best interest of everyone, and be a friend to the borrowers, because they are the only ones who will actually make your bank profitable, and their business depends significantly on the cashes that you give them, and your business depends significantly on their ability to return the cash with interest or with an increment. And that's what makes the relationship very, very mutual between the borrower and the bank. And as long as it's symbiotic and both sides keep their part of the bargain, the relationship actually is very, very strengthened. and I know people who have had the same bank as a relationship for 50 years, 70 years, uh, and and that's because it's been a symbiotic relationship between the bank and the borrower. So thank you so much. And after this, we'll wait for your questions, and we'll try and see like how many of them I can answer. If I can't answer, I'll come back to you with an answer after I search for the answer. So thank you so much for your time. You've been very, very patient. And I know on a Saturday is not an easy thing to do, to be listening to a monologue for over an hour. So thank you. So I will now let Professor Venkatesh moderate the question and answers.
Thank you very much, Mr. Dutta. So may I now invite participants to post your questions in the Q&A section, as in the past. So the focus here is on what happens after a loan goes bad. And you may draw on your experience to raise questions, Mr. Dutta, so you can understand his point of view as well.
We have a question from Khasru, which reads as unwillingness of payment from large borrowers and their undue influence due to their affiliation to political high-ups is is a prime reason for increase in pay. Does it match with Nepal banking industry? Yes. See, name lending or lending to large borrowers because of their affiliations to either politics or to business or an undue influence or otherwise is one of the risks that we run in most of Asia, especially in South Asia. Yeah. So what it means is that it is a risk, but the bank loan managers is personally responsible for collection as far as the law is concerned. So a reason for not taking action on a later date reflects on the bank manager, despite and what action they have taken is what is recorded. So even if a borrower does not pay the loans which they're supposed to, merely because they're exerting influence, the paperwork that the bank has to keep to protect and the bank managers have to keep to protect themselves is very, very important. And I would strongly advise that documentation is something that needs to be exemplary, and that's the only way on an individual basis you would be able to protect yourself. I have a next question from Govinda Gimiri. In Nepalese, the credit assets is increasing and the same time is decreasing. Yeah, see what happens is that, the NPA as a percentage would, even if as an absolute it increases, if your credit increases, which is your denominator, the numerator, which is your NPA, even if it increases, it would still show a lower percentage, because it would show a lower percentage because it gets masked by the higher amount of if the rate of growth of credit is higher than the rate of growth of the NPA will show a higher a decreasing trend, right? It's simple math. If your denominator is increasing and your numerator is not increasing, even if it's increasing at the same rate, it will show a lower percentage. So that's simple math. But what it does is that as long as the going is good, it shows a decrease. And the moment this credit, the borrowing because of the GDP and others come down, let's say COVID, you will actually see this NPA going up significantly in a very short period of time. You watch this after COVID, and you will actually have this. Uh, uh, we will be talking a different number.
Kaushik, there is a
Yeah.
related question in Govinda. So most of the loans are revolving in nature, and the time frame for repayment of principal amount is not projected. I mean, this is a very common practice in many emerging markets. So, you take a short-term loan and keep revolving it. Is this lending system beneficial to banks? And why might banks be doing that? Is it because they are trying to match the asset liability maturity in the balance sheet, like they're working with short-term deposits, and so lending short-term and rolling it over makes better for asset liability matching?
Um, See, a revolving loan is more like a working capital loan, right?
Right.
Unlike a term loan is for a defined period of time, and it's earmarked for what you're going to spend on. It's usually on assets, or usually on things that actually create business infrastructure, right? Or an acquisition or something. Those are the term loans that you take. When it comes to a working capital loan, which is revolving in nature, it is a short-term loan for short-term assets, which is against your current assets. And by definition, your current assets change every quarter, every month, everything. So that's why it actually goes into. So these loans are matched to the current assets, which is a very short cycle, and hence they keep revolving. But what the way it's not a lending system. Otherwise, what will happen is that you will have to do an evaluation after every 1 quarter, let's say. That makes it very, very long. I mean, the business won't survive, because business needs this money all the time on an everyday basis. That's why these working capital loans or the revolving loans are kind of, technically you call them 12 months, but it gets rolled over every 12 months or every 6 months or whatever period of time. So this is a short-term loan against the working capital, and it's not beneficial or otherwise. It's the nature of the loan. It's the nature of the loan is in short term and working capital. The only thing that one has to make sure is that you have enough spread of the working capital that you are covering in the loan. So if the loan is 100, the working capital is 50, there's no way that they're going to cover that loan. So you got to make sure that you only give it at an average, or the money that you lend is say 50% of the total working capital requirement, or 70% of the total working capital requirement, and you are mortgaged, and those working capital is actually hypothecated to you. So it's a system. Rather, it's basically the term loans are long term, and fixed assets, and revolving loans are short term and working capital loans. Does that answer you? Hello?
Yeah, I think Govinda, you can write if the question was answered or not. Now, Prafulla has a question. Due to merger, some policies doesn't match now and then, and for that cause, customer is penalizing and falling on doubtful debt. So we are trying to exit the account, but it's being difficult. Share your Prafulla, what I'm going to do is this, just to make your question clearer. You may like to please ask the question, Prafulla. Can you hear me, Prafulla?
You hear me, sir?
Yeah.
Yeah, please ask the question, and then we
Sir,
can have a dialogue
since
clearer.
okay, sir. Since we have recently merged with one development bank, so the problem is that at the development bank there is a different policies, and now we have a different policy, so that doesn't match some. For an example, the road cases. Like at the development bank, there are certain feet of road can be taken. For example, 8 feet, 7 feet road access can be taken. But now, in our bank, in a commercial bank, that there should be at least 10 feet road access, and only for that region, the customer is penalizing the account turned to doubtful debt, and prior the customer is paying the debt all in time. So I want to know your view in this case.
Hmm. This is actually a very difficult question to answer. Uh, what,
No, because the customer is very genuine. He is not
yeah,
willing for defaulter, like something like that.
right.
Only the reason is that he doesn't has the access of road what we want in our policy.
Right. So one of the things could be that you could, if I were you, what I would do is that I would write to my zonal office to ask for a waiver, because this is a good customer. It's not, and the fact that we have merged should not put the customer in a in any form of difficulty, because the bank has merged. So you'll ask for a waiver and say that this is a good customer and because of XYZ, and you want this clause to be waived in case of his loan. And it would not just be for him, it would be for all other lenders who have got similar problems. So it would not be one customer specific, and it could actually involve many other
Yes,
customers.
yes,
So,
yes,
so if I were you, I would
yes.
actually write for a waiver.
No, as you said, there is not a one customer like this.
Ah,
There might be not only in my branch. There might be lots of customers, lots of good customers in other branch as well. So that management had decided not to take that kind of property. So that is the problem.
see, then unfortunately, what happens is that if the bank has taken a policy and says that this is not, we are only going to lend
Mm,
money to somebody who's got 10 feet access of road, then unfortunately, that's a bank's policy. Then, your view or my view does not really matter.
yes.
That's the bank's view. Uh, the best you can do, and if you if the customer, if you genuinely want to help the customer, is refer him to a bank which will be more friendly towards him. I mean, because your bank is going to not take his, I mean, the
Hmm.
bank will tell him to actually pay back your loan and square the accounts. So bank
Yeah.
policies, I mean, anywhere you work at any point of time, the policies, you may not agree with all the policies
Mm,
of the bank or the company or the
yeah,
government,
yeah.
but they are the government or the banks
Mm-mm.
or the organization's policy. We will have to follow them, right?
Have to go on.
Yeah,
Okay, so thank you so much.
not
Thank you,
at all.
sir.
Pleasure.
Next question by Ananta is a typical moral hazard situation. Borrower can pay, but they are unwilling to pay and they want to use the pandemic as an excuse. Is it possible to distinguish between who is using it as an excuse and what is a genuine case?
I think there are two parts to it, right? One is that, is the interest meter running or not? Uh, Even if they are not paying now, the interest meter is running, right? So the interest is being accrued. And if the rules, for instance, in some countries, they have actually extended the rules of the non-performing assets, right? If the assets are not, if the assets are going to be non-performing, say within 6 months of them not paying it, then they are at a disadvantage by not paying the interest, even even if it actually helps them in a short period of time of not paying it. So it depends on two factors. One is that what is the government's policy on moratorium on pandemic, and what is the Nepalese government's policy on NPAs in the time of pandemic. Once you look at those two, then you will actually get the answer much clearer. If the government actually gives the borrower a moratorium, then the borrower can actually take the moratorium. If the government hasn't given them the moratorium and that they are not paying, then they have done a contractual violation with the bank. So you have to see it under two parts. One is that what is the government's rule on the moratorium on the pandemic, and that would actually determine what their rights are and what your rights are, and you'll have to deal with that according to those rules. Apart from that, there is nothing else you can do. Either it's a contractual violation, or during pandemic, the government has actually come up with a new rule on moratorium and NPAs. And I cannot think about any other answer on this.
Yeah,
So
I think there is a little bit of gray area, because I think the government policy on this is not fully spelled out yet. Not in Nepal, not in Sri Lanka.
Okay.
So I think all banks are still looking for clarification on this. So maybe this will persist till maybe a few weeks, by which time it will become much clearer.
Yeah, in India, the banks have been given, all borrowers have been given a 3 to 6 months of moratorium. But your interest has not been suspended. What has been suspended is that you do not have to pay for the next 6 months, but your interest meter is going on.
Yes, and also that the banks don't have to provision for these accounts.
That's correct.
The banks don't have to provision for these accounts.
So in this case, if government hasn't given any clear direction, then it's a loan agreement that actually becomes important. But at the same time, because it's pandemic, you have a reputational risk to deal with, and your bank would also need to have come up with very, very specific instructions on how to deal with customers not paying during the pandemic, because it cannot be every individual interprets the pandemic rules differently. Then you will have a different public image issue altogether.
Okay, now the next question, Ram is saying, basically, this is working capital lending, but it's backed by a combination of working capital assets and long-term assets as collateral. And so if this goes bad, then of course the working capital is not enough. And how do you recover? Can you lay your hands on the land and building also in order to enforce? What is your experience on it?
See, in my experience, usually for a working capital loan, you would actually take working capital assets and you would take a guarantee from the promoters or collaterals from the promoters. Anyone who's taking money on working capital would have hypothecated the land and building for another term, for a term loan. So it's very unusual that they will only take a working capital loan and give you a fixed asset, which they have otherwise not given as a security. If you can get a building as an additional security or a collateral on top of your stock and trade receivable, it's fantastic. But usually the working capital loans don't need land and building as a collateral. You normally take a guarantee or personal assets of the promoter. But if anyone is willing to give you a better asset, an additional asset of land and building on your working capital, I would just say take it. But usually you would not find too many borrowers offering it. But if you find it, I would take it. And the thing is that if you can always sell the land and recover the balance, if the working capital is not enough to pay back the loan, you can always sell the land and building and get and recover the balance amount. But having said that, to sell land and building takes years to be executed.
Okay, I think you know, the point that Mr. Datta is making also relates to what type of land and building these are, you know, and sometimes these may be difficult to enforce, even if they are, you know, if you're perfectly within your legal limits to do that, right? And now Nawal's question relates to another point that Mr. Datta made earlier. Interest meter is going on in this COVID-19 pandemic period. Borrowers are not paying, they're not willful defaulter. Now, when he says overcome this situation, so what I think it means is how will this end? You know, so now the government has given a 3-month or a 6-month moratorium. Interest meter is going on, but at the end of this period, if the business is still not back on its feet, what will happen?
See, then you go back to the same position. You go back to the normal contract between the banker and the borrower. See, the central bank or NRB can only put in rules up to a point. Beyond that, it actually becomes a contract between the borrower and the lender. If the borrower hasn't paid after the moratorium or whatever is the government intervention, then you treat it as a normal business contract and you would proceed accordingly. So if they have not paid after the moratorium period, you would classify it as an NPA, and you would go into all the debt recovery rules that are applicable in Nepal.
Or in other words,
pandemic only suspends it for a period. It does not take it out forever.
Or in other words, despite this moratorium, the risks to the banks still remain.
Yes, and also the liability of the borrower hasn't gone away. It's only suspended.
In general, what is the outlook? How long this will take for at least the SME type of borrower to come back to normal?
You see, there are some businesses which are gone for a long period of time. So if it's hospitality, restaurants, entertainment, recreation, anything that has got high discretionary spend, that will take, we don't know. It could take 1 year after the pandemic actually gets subsides. Nepal has got a much lesser problem than India, so in Nepal it would turn around much quicker. But it would still, see, if a business is closed for a few months, for them to generate the cash flows and also for customers to get there, it's somebody's guess. So if a business cannot survive for 6 months, 4 months to 6 months without cash flows, those businesses will go bust, and those businesses will actually become, that will create NPA risk for the bank. So it's a question of how strong the SME is to sustain without the cash flows for a period of time, whether it's 3 months or 6 months or 9 months is a guess. Some businesses will actually come back quicker. Some businesses probably will get suspended for a long period of time, and lots of businesses will just close. But we don't know which one.
Yeah, I think there will be a combination of issues, and there might also be certain moral hazard problems, you know, where some businesses will take this opportunity to actually close down and get all the concessions possible. You know?
Yeah.
So I think the banks have to be prepared for that as well. Now Santosh says, how much risk is there to lend against foreign banks' counter guarantee? Kaushik, you might know more about this question.
I'm trying to actually get the questions. Yeah. Santosh.
Maybe I go to Santosh and allow him
Yeah.
to voice the question so it can be easier to understand. Uh, Santosh, can you ask the question, please? Hello? Santosh, are you there?
Yes, sir. Yes. Can you hear me?
Yes,
Yes,
we
yes.
can.
Yes, sir. Thank you, sir. My question is, how much risk is there to lend against the foreign bank's counter guarantee?
See, the first thing is, the quality of the foreign bank under whose counter guarantee you're giving. So if this is guaranteed by, let's say, Morgan, JP Morgan, or not JP Morgan, let's take a
I
big
mean
bank.
that acceptable foreign bank's counter guarantee
No,
in
that's what I'm
Nepal,
saying.
Nepal's
Yeah,
bank.
if you have an acceptable A-class international bank's counter guarantee on a loan, uh, I would think that that is a reasonably acceptable risk. Uh, the huge provision would come only if the bank against whom you have given out counter guarantee actually fails. So that's why, acceptable bank. If it's an acceptable bank, it would last for the period of the contract. What's your view, Santosh?
Santosh, is there a specific example around which you are asking this question? Can you elaborate on this?
Yes, due to the recovery program of Nepal Investment Bank, recently the one of the Italian bank has to pay two 20 million, I think 20 million amount to the Nepal Investment Bank.
Okay.
Uh, so I asked this question.
You see, what happens is that you would uh, any international settlement takes time because you will actually fight this in an international court. So in case if your say court of jurisdiction was uh, let's say London, you will have to fight this case in London. If your paperwork and everything and the bank and the foreign bank's counter guarantee is a liability in your case, and you prove it in the in London or whichever is the point of wherever you're fighting this suit, the once you win, you will get paid. Uh, it's something like any other one who's giving a counter guarantee, whether it's a foreign bank or whether it's a local bank. Uh, if there's a dispute, they will go to the court. So in the court, whatever time it takes, the time will take. So hence, whether it's a foreign bank or whether it's a domestic domestic bank's counter guarantee against which you're giving, it's a question of how long does the legal process of enforcing your contract takes. It's very much
Yes.
like same way like about your borrowers, right? You might have the perfect paper, but if the borrower decides not to pay, you have to go to the court and enforce it, and that might
Yeah.
take 5 years, right? So it's
Within
not a
within
question.
within within that period, they have to provision huge amount so that their profit decreases down.
Yes, but if it's a claim that is reasonably backed up, one could actually say that you may not it under the NPA norms, you would probably you will have to provision. But if it's a sovereign and if you got very good guarantees on it, you might actually still say that this is disputed, but not to be completely provisioned. So those are some of the views between the bank and the auditors they'll have to take.
Thank you, sir. Thank you very much.
Not at all.
Now, Basant says, how do we assess the requirement of working capital term loan, need of borrower and amount deemed? Basant, I'm going to turn your microphone on because the way I understand it is that it seems that sometimes the borrower is asking for more than what they need, and the yes, Basan, please go ahead, and that may not actually be the need of the borrower, right? So, Basan, please go ahead and elaborate on the question. Please.
Okay. What
And
I
hear
meant to
you.
say, what I meant to say is, actually we are providing loan,
Right,
working capital term loan generally, just structuring the facilities
right,
instead of understanding the customer's demand
right.
or what the business actually need for.
Mm,
Just managing as our product waiver allows, we categorize certain part of the loan as a working capital term loan.
right.
That in generally, principally, what it is accepted is we provide term loan for slow moving assets or slow moving
Mm,
trading goods.
right.
And actually, such slow moving trading goods may not be traded further in course of
Mm,
time due to outdated might it be. And in
mm.
such case, what can be the possible way to identify the actual working capital term loan need of the borrower, and how can we identify the actual amount that the business is need of?
Okay, I have a point of view on that, but Kaushik, you want to go first on this?
No, you go first. I'll follow you.
Okay, so Vasant, the first thing is that we have to take into account the nature of this business. If there are certain seasonalities, cyclicalities involved, basically seasonality in case of working capital loan, then we need to understand whether, for example, businesses that are building inventory around upcoming festivals, let's say firecrackers or something like that, right? Then the piling up is justified. But let's say if the day's inventory is steadily climbing, and it has nothing to do with the seasonality. It is simply slow moving, for whatever reason, low demand, out of fashion, whatever it is. Then the underlying security itself is at risk. For example, if there is a distressed sale of the inventory, it may not cover the capital. And in the books, they will always value it at cost. Usually they find a way not to mark it to the market. So my suggestion would be, the first thing that you need to check is, what is causing this, increase, so that a part of the working capital becomes a permanent fixture requiring a term loan. So in certain cases where the production is evened out and the demand is seasonal, I think there is some justification. But in many cases where the inventory should be moving quite quickly, uh, then I would be suspect about the requirement. Uh, Kaushik, you want to go, and then we will get back to Vasant and see whether we addressed what he has in mind.
Yeah, it's it's a judgment, right? How would you exercise your judgment? How much working capital does your client need? One is that they will actually give you projections based on which you determine the working capital. Second thing, you could actually look at that if you have led to similar industry, so what is the working capital cycle in that industry for small businesses, medium businesses, large businesses? So that would actually give you an idea of how many months of turnover is actually in working capital, which is basically your inventories, which is your debtors, and netting them off against creditors. So that is what the business would need. So if they're asking for more than what the working capital need is, you'll have to then they have to give you a good reason why they need more, and the reasons for it, and you have to be satisfied. Normally, you will only lend up to 75% of the working capital. So that means you actually keep a headroom so that the business actually, the promoters and the business owners bring in that amount of capital, which is their skin in the game. And if it's a slow moving working capital, then you will have that amount of heightened risk in the loan, because the liquidation of that asset takes that much more longer, and you would either factor that through a higher interest, or through any other mechanism of saying that you would only lend 50% of X number of assets and 75% of other assets. Uh, so normally that's what you would do. It's basically, for every industry, you would try and see what is the normal working capital turnaround, and then determine how much money they would need. So it's a judgment. So there is no uh, back end there's no straightforward answer to it. So it's a judgment, and every bank actually prepares their own uh, working capital norms for different kinds of industries and different kinds of borrowers.
Basant, does it answer your question?
Yes, sir.
Okay. Now, Nawal says due to the current situation, NPA will increase. But income is going to go down, and the collateral will be difficult to enforce. So this will deepen the problem of the bank for recovery of loans. What suggestions?
Honestly, this will be a worldwide problem, not just your problem or my problem, or because there will be more. It's a simple thing. If more and more uh, borrowers fail to repay their loans, you will have more assets which will be out there in the market. So they will have a high supply and less demand, because people don't want to spend and put in more money in assets that they otherwise would not buy. And hence the bank will recover either lower amounts, or bank will have a huge pile of these assets which they have got as a collateral. There is it's a macroeconomic problem. I don't think I can actually solve this, or any one of us sitting on this call can solve this, because it will be the markets that will determine that how much we recover from each of these collaterals. And what you can reasonably expect, that banks will actually take a haircut, because there won't be sufficiently buoyant market on buying this collateral in the short period of time. So unfortunately, this actually would be a risk, and I don't think anyone has got an answer that how best you can create a market for collaterals under the current scenario.
One additional point, Nawal, is that I have been talking to banks in the region, and then some of them have this dilemma that they have to overcome. Now, these borrowers who are going to be in trouble, they are going to make additional demands on you. So they will say that, can you help us further to tide over this difficulty? Now, against this, you have to consider the alternatives. So it is sure that the economy as a whole will suffer, but it's also clear that some segments of the economy will do better than others, right? So, for example, the Standard and Poor in Singapore, they have produced an analysis where they say, tourism and restaurants, etc., will suffer. But on the other hand, there are industries like healthcare, etc., which may actually do better. So the choice for the bank is that where should your money go? And here I think each country will offer its own unique lesson. So what are going to be the sectors that will do relatively better in Nepal, and where are going to be the real pain points? So the lending that you have done in the past is one thing, but where should your money go in the next couple of years? that is a choice that you can still make. Should it go to prop up your existing lenders, or should it go into sectors, that show more promise in the crisis economy? Now, in a business, Govinda says, customers have to maintain a certain level of working capital all the time, and they tend to be financed by revolving nature limit or fixed term loan. So, Govinda, I'm going to take you live so you can ask the question, elaborate a bit if you can. Govinda, please go ahead. Govinda, can you hear me?
Govinda, your mic is on mute.
My mic is okay. Govinda? Okay, let me try again. Govinda, you can talk. The mic is open now. Hello? Govinda, are you okay? Can you type something if you cannot reach the mic? Oh, I think we lost. He's not here in the list. Okay. Oh, Govinda has left. Okay. So I don't know what happened. All right. So if there are no further questions, let's join.
Should we answer Govinda's question or leave it?
Go ahead. Can you see the question here?
Yeah. The fundamental principle is that you would have short-term loans or working capital revolving loans for short-term for working, short-term loans for short-term requirements, long-term loans for long-term requirements. The fundamental principle is that long-term loans create assets. If you divert that for short-term use, you will not have the capability of investing in the business, and hence mixing up term loans with working capital actually is detrimental to the business's long-term perspective, because you're taking away your future investments in fixed assets and infrastructure and all other long-term business activities, and you're using that for short-term needs, and that creates the complete mismatch of your capital needs. So all banks make sure that you do not use your long-term loans for financing your short-term working capital needs. And I can tell you, in India, the auditors actually have to make a statement in the auditor's report whether the borrower has used long-term capital for short-term needs or short-term capital, and have they, or whether they have diverted any short-term capital for long-term. Professor Venkatesh? Hello?
Dr. Venkatesh?
Professor Venkatesh? Hello.
Hello, Mr. Dutta?
Yes.
Yeah, Dr. Venkatesh has something else. So,
Okay.
yeah.
So,
If there is no more any questions, you answer on the question.
I guess so. Govinda, did you get the answer of your question?
Govinda, I allow you to talk. Govinda?
All right.
So it's no answer from Govinda as well.
No, I answered this question for the others, so it's recorded, so he can actually, when he sees the recording, he can get the answer.
Yeah. So,
Yeah, we do not have any. There's a new question.
we do not have any further.
No, just hang on. We got just one more question. Okay, Govinda's network is. I have a question from Santosh, which says, can you share your opinions on how to manage a problem loan in current situation? It's a very, very difficult one. See, the thing is that the balancing of bankers need to be sympathetic to the borrower and also to protect the loan from going bad. It's a very, very tough conflict, especially in a pandemic. So here is what I would do if I was in your place. It would depend on the borrower. If the borrower is somebody who you have a long-term relationship, and or even if you have a short-term relationship, it's a borrower that is really a highly rated borrower, has got high credit score, have got very high business integrity, has been keeping all their commitments. You would actually support such a borrower, because after the pandemic is over, you would need all your best customers to be stayed with the bank, because when the business turns around, and it's a question of when do you pull the plug from a loan? If your borrower is actually, like the question that was there, was already is in a position to pay but is not paying, is diverting assets, is actually taking away money from the business, then you would actually then you would uh, then you would actually go in for the recovery process quickly. But if it's a borrower who's in genuine difficulty and will overcome this, because it's a question of a 6 months, 1 year, because then you would actually try and see how much support you can give within the banking within your banking rules and regulations, because not to forget, you need all the borrowers after the pandemic is over and when the economic cycle is on. And if you lose them when the times were hard, you'll never ever get them back. So you would have to. There is no one answer. It would depend on the borrower and how do you think your relationship with the borrower will be there after in the long run. If it's going to be a borrower for you in the long run, you would actually do whatever is necessary and within the banking rules to be supportive. But if they are somebody who's breaking your business contract and doesn't have high level of ethics, you would try and recover your money as quickly as you can. So there is no straight answers. It will depend on a case to case and and based on the banks and the branches' risk appetite.
Thank you, sir. I just wanted to share your opinions in this situation.
Thank you so much. Yeah. I think we answered all the questions.
Okay. So please join me in thanking Mr. Dutta for his time and sharing his experience. Now, I will be sending a message to all of you. So we need to fix the date for the final test. So I will discuss with Mr. Sharma and fix this date. And after that, we will also fix a date for a seminar to wrap up this module and also define what we will do in the Thailand module when that happens. So have a wonderful day, and please wait for my messages on WhatsApp, and we will set up a meeting and a test date very soon. Thank you so much, and thank you, Mr. Dutta, for joining us.
Pleasure.
And thank you all. Yeah.
Thank
Have a good
you.
day. Thank you.
Take care. All the best. Stay safe.